Okay, capital assets. Capital assets are kind of weird. There are lots of rules that go along with them because they've got some special tax rates. So, how we treat a capital gain or loss. Remember that capital assets are personal use property and investments. It's going to vary based on several factors how the disposition is treated for tax purposes. We need to know how long the capital asset was held. Again, that 1 year is important. That's a cutoff point. Less than 1 year, more than 1 year. Short term, long term. Was there a gain or loss when we sold it? That's going to determine how we treat it as well, if there was a gain or loss. The type of asset that was sold. So there is a special category of capital assets called collectibles that have a different tax rate. Okay, and so they're gonna be treated differently. The taxpayer's own tax bracket. Remember with the dividend tax rates? You remember that, right? Where we had to pull that out and tax at a different rate. Same thing. These are the same dividend tax rates. These are the capital gain tax rates. So what that tax rate is, what that capital gain tax rate is, depends upon the taxpayer's other income. Okay, so we have to look at what their other income is, what tax rate they're in. That will then determine what our capital gain tax rate is. The combination of all capital gains and losses to derive a net capital gain or a net capital loss. We have to combine, because you might have sales of multiple assets, multiple investments, right? Say you've got, you sold a bunch of stock. You sold 10 different stocks. Some of them were short-term, some of them were long-term, some of them you had gains, some of them you had losses. You got to combine all that, but you have to do it in a particular order to determine what our net capital loss or capital gain is. And this one, which we don't really go into very much, but whether the capital asset sold is stock of a qualified small business. So like an S corporation, certain types of S corporations. So let's talk about the holding period first. So long-term capital gains are the ones that get that special lower tax rate. Only the long-term ones. Short-term capital gains do not get a preferential tax rate. They use ordinary tax rates. Okay? So long-term is any asset held for more than 1 year. Long-term equals greater than 1 year. Greater than, not greater than or equal to, but greater than 1 year. So 1 year and 1 day. Okay? Short term is less than or equal to 1 year. So exactly 1 year is short term. So remember, the holding period starts the day after if it's a stock. So again, let's say I purchased a stock today. My holding period is going to start tomorrow, October 16th. If I sell it October 15th next year, that's exactly 1 year, 365 days, right? That means it's going to be short term. If I wait 1 more day, then it's going to be long term. And my tax rates are going to change, right? Between those 2 days, my tax rates are going to change. Holding period starts the day after the taxpayer acquired the property, includes the day that the property is sold. All right, so we got Jackie purchased 100 shares of IBM on January 6th. Stock is a long-term asset as of January 7th. If she sells it before that, then it's short-term, and she doesn't get any preferential treatment. Okay. Now, if it's a loss, it doesn't really matter as much, right? Because you're not talking about tax rates there. In fact, sometimes people will sell assets intentionally at a loss in order to offset other gains with that netting process. You'll see why when we go through that. So what if an asset is received by gift, non-taxable exchange, or an inheritance? So if the property received has the same basis as the basis in the hands of the transferor, so if it's a gift, the holding period will include the transferor's holding period. So everything just transfers over. Grandma gives you 100 shares of IBM that she bought in 1974. Well, you're going to get her 1974 basis, but you're also going to get her 1974 holding period. Okay, so it all transfers over. If it's inherited property is always going to be long-term. So if grandma just bought those shares yesterday, and then she passes away and you inherit them, they're going to be long-term, even though she just bought them yesterday. Okay. All right. These are, okay, you know how I said that collectibles have a special tax rate? It's 28%. 28% is the collectibles gain, which is higher than the tax rates for a lot of people, right? Probably for most people. 1202 gain, that's that small business stock that they mentioned up here. Qualified small business stock. That also has a 28% tax rate. This unrecaptured 1250 gain, we're going to talk about that when we get to the trade or business sale of trade or business assets that were held for more than 1 year. All right, capital gains based on taxable income. Highest, this is long-term, by the way, so these are just long-term capital gain tax rates. If your income is over one of these thresholds, depending upon filing status, tax rate is 20%. So for married filing jointly, your taxable income has to be over $553,850 to get into the 20% tax rate. That's quite a bit. This is the bracket. These are very big brackets that get you into the 15% tax rate. So married filing jointly, you can see between $89,251 up to $553,850. That's a huge range. So a lot of people, probably most taxpayers, would be in the 15%. Again, only long-term gains. Short-term gains don't get this preferential rate. They get the regular rate. The lowest, if you are under, so married filing jointly, up to $89,250, you get the best tax rate of all, which is 0. So those individuals who, again, this is taxable income. So that very last number on the first, so after the standard deduction, everything, if it's under $89,250 for married filing jointly, you're not going to sell stock, long-term stock, you get the 0% tax rate. Let's see here. Oh, we got plenty of time. All right, so let's look at this example here. Matthias gave a gift of 500 shares of General Motors stock to Sienna, sibling, on November 12th, 2022, when the stock was worth $50 per share. Matthias had originally purchased the stock for $30 per share in 1992 because it was a gift. Sienna's basis in the stock is still going to be $30 a share, and it's going to be long-term holding period because it was a gift. If she inherited it, she'd get the $50 a share, and it would be long-term as well. All right. So this is about the tax rates. Yeah, the income, so as you can see, the tax brackets do not match up with the ordinary tax brackets, obviously. So ordinary gain, let's see. Oh, that's what we just went through. We've got Basha, married taxpayer, files a joint return. 2023, their taxable income is $115,000. Sold stock in April 2023 that was held for 4 years. So is that short term or long term? Long term. Gain on the sale was $30,000. Basha is in the 22% tax bracket. The $30,000 capital gain is taxed using a 15% tax rate. Most people are going to fall in that 15% area. All right, that 25% bracket, which we're going to talk more about in the next section here, applies to capital gains that are generated from depreciable real property used in a trade or business. So there are special rules for depreciable real property. This is only real property used in a trade or business. That's called 1250 property. So when depreciable real property is sold for a gain, the taxpayer has to recapture as income the part of the gain that was due to the difference between maker's depreciation and straight line depreciation. Now, there's a problem with this because we don't use maker's depreciation for real property. We only use straight line depreciation for real property, but that's not the way it used to be. So whatever the difference was between those two was supposed to be recaptured and taxed at this special tax rate, this 25% tax rate. All 1250 property is depreciated using the straight line methods. Therefore, there is no recapture of depreciation. However, IRS has decided they needed to implement a special provision for this non-recaptured depreciation of real property. Instead of the entire gain from 1250 property being taxed at preferential capital gains tax rates, the gain attributable to any depreciation is taxed at a special 25% rate, and any gain in excess of this amount is given the preferential capital gains tax rate. Essentially what this means is that any amount that has been depreciated for a property is going to be taxed at 25%. Now think about this. When you depreciated the property, it offset ordinary income, right? You got the benefit of it reducing your ordinary tax rate. So they don't want you to then get the benefit of getting capital gains tax rates on property that you had depreciated or had, what am I saying here? They don't want you to then get the benefit of a preferential tax rate on what was an ordinary deduction. I'll do an illustration here to show you what I'm talking about because I know my words are. So the IRS, this is the depreciation capture. So taxpayer must include depreciation deductions whether they actually took depreciation deductions or not. That's that allowed or allowable part. All right. Oh, here we go. They've given us an example. And it kind of helps to write it down. So Mustafa purchased a business building in November 2009 for $200,000, assumes that $69,655 of depreciation was taken on the building. Adjusted basis is $130,345, so which is the $200,000 minus the $69,655. If he sold the building for $190,000, the gain on that would be $59,655. It would be subject to the 25% tax rate because all of that gain is attributable to the depreciation. So, $200,000 building, purchase price, right? Depreciation was, what did they say? $69,655. So our adjusted basis is $133.45. All right, and then he sold it for sale price. You realized $190,000. So his gain was, what they say, $59,655. All right. What you do is you look at the gain. If it is essentially all of that gain was from depreciation, the building didn't increase in value, right? Because it went from $200,000 to $190,000. It did not increase in value. There's no appreciation of the building. It's only due to the depreciation. Now, he had gotten preferential deductions over the years for that $69,655, right? And it helped to offset his ordinary income. So what the IRS is saying is, well, all of this gain really is only due to the depreciation deductions that you took. None of it's due to appreciation of the property. The capital gain part and the preferential treatment is it can only be due to an appreciation of that property, not a depreciation of that property. So therefore, they're going to tax this at a higher tax rate, that 25% tax rate. So let's just say instead of $190,000, he sold it for $230,000. All right, $230,000. So the gain is $103.45. All right. Well, now $30,000 of that gain was due to an increase in value of that property. That's going to get preferential tax treatment. You get capital gains tax rates for that one, that part, for the $30,000. But for the remainder, the amount that was depreciated, it's going to be that higher tax rate of 25%. So what you can do when you calculate the gain, what I would do, subtract the depreciation. I get that right, 345, adjusted basis. Oh, I subtracted that wrong, didn't I? I'm sorry, this is not the right gain. This is probably 655, because I was subtracting that. Is that right? Yeah. No, 99, sorry. Whoop. 99,655 is the gain. Sorry, I was going the opposite direction there. So, take that. This is going to be the 25%. This is the capital gain part. So you have to separate out those two. The other way to do it is just to look at it as appreciation. How much did it go up in value? Right? Well, that's pretty, 230,000, we bought it for 200,000, we sold it for 230, it went up in value 30,000. That means that amount of the gain is due to appreciation, which is going to get that preferential tax rate. Does that make sense? So you got to separate those two parts of the gain out from each other. If you sold the building for $220,000, well, it's a different example from mine. $220,000, the total gain would be $89,655. Of that, $69,655 would be subject to the 25% rate. $20,000 would be a 1231 gain subject to a potential 0, 15, or 20% rate. Okay. 28% capital gain rate applies to collectibles gains. So what is a collectible? Work of art, rug, antique, metal, gem, stamp, coin, or alcoholic beverage. held for longer than 1 year. I have some bottles of wine that are older than a year, but they're not a collectible. 28% rate also applies to 1202 gains. Those are the gains for qualified small business stock. That's stock from any domestic corporation whose aggregate gross assets up to the date of issue have been less than $50 million. That's a small business, less than $50 million. Gross assets. So if a taxpayer other than a corporation purchases stock, gross income exclusive of the gain, yada yada. They've got a special tax rate for that. I'm not going to go through that. All right. I'm not quite sure why they put this in here. I mean, it's relevant, but I'm not sure it's relevant to this information, but okay. So, you know, we've got that additional Medicare tax on incomes over $200,000 and all that. There's another tax, Medicare tax, but it is applied on net investment income. They call it NIIT, net investment income tax. So for individuals who have a modified AGI above a certain amount, I think it's $250 for married filing jointly. There's an additional tax on certain types of investments, interest, dividends, rental, and royalty income. I'm sorry, all types of investments, but those are some of the more common ones. Gains from sale of stock, bonds, mutual funds, capital gain distributions, also the dividends, interest, all of that stuff. So anything that's considered investment income. There is a 3.8% surtax, which goes to, I guess, the Medicare program. The lesser of, and the amount is going to be, the base of that tax is going to be the lesser of the net investment income for the year, or modified adjusted gross income over $250. How do I say that? Well, it's still only going to be the net investment income. That's worded funny. Because it's only on investment income. How this is worded, it sounds like if you've got income over that amount, you're going to pay the net investment income tax, but you're not if you don't have net investment income. All right. So let me show you how this works. Single taxpayer who has net investment income of $40,000, modified AGI of $180,000. So for single, you have to have modified adjusted gross income over $200,000 for this tax to apply. Okay. If they have $40,000 of net investment income, they're not going to have any of this net investment income tax. However, if they have net investment income of $40,000 and modified AGI of $210,000, then the surtax is going to be on the amount over this $200,000. If their modified adjusted gross income was $250,000, then it would be applied on all $40,000 of that net investment income. So let's say that you are married filing jointly and you have modified AGI of $270,000 and you have net investment income of $30,000. All right. So what you do is take your modified AGI and subtract these thresholds. So 270, this marker is going to be hard to erase it. Just know it. Oh no, it's not bad. So take the modified AGI minus the threshold, that based on filing status. Compare that to that and take the lesser of those two is subject to the net investment income tax times the 3.8%. Okay, so you compare those two. So let's use a different number. Let's use 400,000. 300,000 of it is net investment income. So 400,000 minus the 250. Now this is not the lesser of those two. This is the lesser. Okay? So it's still going to be limited to only the amount over that threshold. Okay? But whatever's less. Does that make sense? All right. Oh, the fun part. Oh, let's see. Maybe this is a good place to actually stop. I'll just give you a little preview here, okay? So, capital gains and losses, you have to net them together. Like I said, in my example, you sold 10 different shares of stock. Some of them had gains, some of them had losses, some of them were short-term, some of them were long-term, all over the place. You have to combine them all, and you have to combine them in a certain order before you can determine what the tax treatment is. So after all long-term and short-term capital gains and losses have been calculated, they have to be combined in a certain manner before applying the special tax rate provisions. First, you combine all short-term capital gains and all short-term capital losses to obtain a net short-term capital gain or loss. So let's just say we had short-term loss, short-term gain. So this is 1,000, and our gain here was 1,500. We're going to combine those two for a net short-term gain of 500, right? And then we've got long-term losses, long-term gains. Let's just say we had 7,000 of losses and 4,000 of gains. So we're going to combine those two to get a net long-term loss of $3,000. First, combine all short-term capital gains and short-term capital losses to obtain a net short-term capital gain or loss. Next, combine all long-term capital gains and losses to obtain a net long-term capital gain or loss. Finally, combine the net short-term gain or loss with the net long-term gain or loss. So now we have to combine these two. We have a net long-term loss of 2,500. If the netting results in a net short-term capital gain and a net long-term capital gain, or a net short-term capital loss and a net long-term capital loss, the netting process ends. So if these were both gains, then we would have a short-term gain and a long-term gain. If they were both losses, we would have a short-term loss and a long-term loss. And that's what would show up on the Schedule D. But we didn't. We had one was a gain and one was a loss, so we combined the two to get this net long-term capital loss. Let's see. You also have to separate gains that are taxed at 28%, collectibles, and Section 1202 gains. If an overall net loss results, you can deduct up to $3,000. So let me change this for a second. Let's say this is $10,000. Now we've got a $5,500 loss. Net long-term capital loss. We can only take $3,000. Only up to $3,000 a year can offset other income on your tax return. So your maximum capital loss, total capital loss, cannot exceed $3,000. There's no limit to the gains, of course, but there is a limit to the losses that you can take. So what happens then? Well, it gets carried forward and it gets added to the next year. So now we would have $2,500 long-term loss carried forward to the next year. That's then, and it's going to retain its character, so it's going to get combined with these other long-term losses next year. So if you have some gains next year, now you've got $2,500 that you can use to offset those gains, right? Only the gains are going to be taxed. The losses, though, you are limited to the $3,000. So here are the possible outcomes: short-term gain and long-term gain. So that would be if we had both gains. Short-term gains would be taxed at regular tax rates, whatever the ordinary tax rate is. Long-term gains are going to get one of those preferential tax rates. Short-term gain and long-term loss, that's what we had here. Long-term loss is offset against the short-term gain. If a net short-term gain results, the short-term gain is taxed at regular rates. If a long-term loss results, that's here, you get the loss up to $3,000 to reduce other income. Any additional amount carries forward forever till you die. Death and taxes, right? If we had a short-term loss, which we didn't, and a long-term gain, we have to separate the long-term gains into the 28%, 25%, 15, and 0% groups. Short-term loss is going to offset the higher tax rate first, which is good. That's preferable. Then the 25%, and if any loss remains, these other lower tax group rates. Net short-term loss and net long-term loss, only $3,000 of the combined loss is deductible against the other income. Short-term losses are deducted first, and then if any $3,000 maximum remains, you deduct the long-term loss up to the maximum $3,000. Again, it's going to carry forward, whatever the carry forward is, it's going to carry forward with the same character for the next year. So another one of those reasons why you always have to, when you're preparing tax returns, you always have to look at the prior year's tax returns to see what happened, especially if you didn't prepare that tax return. If you prepared the tax return, this kind of stuff carries forward in the software. So you don't have to, I mean, you always should double check it, but you know, it's there. If you didn't prepare it the year before, then you've got to enter all of this information in so that you make sure that that carry forward, because otherwise they're going to lose out on, they're going to pay more in taxes than they have to, right? excess losses carried forward to the next year retain their original character. Short-term loss is a short-term loss, long-term carries over as a long-term loss. Let's see here. So Adrian and Pat Reynolds sold property 2023. Sale was a long-term loss of $8,000. They had no other capital transactions, filed a joint return 2023. They had 2023 taxable income of $5,000. They can deduct $3,000 of the loss in 2023. The unused $5,000 carries over to 2024, still is a long-term loss. If their loss had been less than $3,000, there would be no carry forward in that case. Again, if they don't have any gains next year, they still can use, of that $5,000 that's remaining, they can use $3,000 next year to offset other income. And then they would have $2,000 that would carry forward to the following year. Doesn't matter what the filing status is, it's $3,000. So unfortunately, married filing jointly does not get $6,000. Another one of those marriage penalties. Because if you were married filing separately, you both get, well, if you were single, you would both get $3,000. I'm not gonna go through this right now. Or maybe at all. Let's, where are we? 30. Yeah, I guess I will do this since we've got some time. Okay, so this 80, I hadn't mentioned the 8949. The 8949 is kind of a source document for the Schedule D. So the 8949, when you've got capital assets, the first form you fill out is the 8949. And you may have several Form 8949s for one tax return. You'll see that on this 8949, you've got some choices up here. And each of these, this check mark will pertain to every transaction on this single 8949. So here, short-term transactions reported on Forms 1099-B showing that the basis was reported to the IRS. 1099-B is the statement that brokerage accounts send out for sales of securities. Okay, so it would be reported if you got a 1099-B and you had short-term transactions and the basis is listed on that 1099-B. It might not be, because if it was an asset that was transferred into the brokerage, they might not have that information. But if it meets those requirements, then every transaction that you had that was short-term, reported on a 1099-B, and where the basis was reported is going to be on this form. Maybe you just had one, and that means only one item is going to be reported on this form. But you had several other sales. Well, maybe you had short-term transactions reported on 1099-B, but the basis wasn't reported to the IRS. Now you're going to need to have a separate 8949 for all of those transactions, and then that box will be checked. See, short-term transactions not reported on a 1099-B. Those might be private party transactions, right? If you had a piece of land that was sold, you're not going to get a 1099-B. 1099-B is for brokerage accounts. We have lots of different investments that are not in brokerage accounts. So all of those types of transactions will have their own 8949. Notice these are only short-term listed here. Guess what? There are other long-term ones as well. Let's see. They're not going to show it. Oh, I guess so. So this is just a snippet, but long-term, same parameters. 1099-B, basis. 1099-B, no basis. No 1099-B. Again, so you could have, well, I mean, you could have transactions that span, this goes down, I don't know, maybe 15 rows, 15, 20 rows, something like that. But you could have pages and pages of these, depending upon how many transactions there were. Or you could have 6 pages and a single transaction on each one, because you only had one short-term transaction that was reported on a Schedule B or a 1099B with the basis. So this is where it all begins. Then all of this information gets transferred over, and again, this is just for the capital transactions. All of that then gets transferred to the Schedule D. Schedule D is divided up short-term gains and losses in Part 1. Each of these, so if the box A was checked on one of those forms, so these are, that's D, E, F. That's A, B, C, D, E, F. So we got those 6 boxes. So whatever was in box A, the totals we're going to transfer here. Whatever was in box B, the totals we're going to transfer here. Box C, here. These are all short term. Those all get netted. This is where the netting of the short term comes in. Gain or loss, all of that transfers again. So if you have any capital loss carryover, that would be entered there from last year. Then go down here to Part 2, long term. So again, box D, box E, box F, all of that stuff here, long term's all going to get netted here. So that very first step that we did, this is Part 1 of the Schedule D, this is Part 2 of the Schedule D. Okay? Again, long-term capital loss carryover. These capital gains distributions, we're going to talk about that in the last part of this chapter. These are, well, I'll just talk about it in the next part of the chapter, but that is a common box to be filled in if somebody has a 1099. If they have a brokerage account, oftentimes you'll see capital gain distributions, and we'll talk, like I said, we'll talk about that. It's the last part of the chapter. So all of those then, long-term capital gain or loss, this part here gets totaled there, and then the rest of the netting, combine lines 7 and 15, so that's our short-term losses there, and our long-term, that's part that's here, where we're combining it. And then it gives you the instructions. So if it's a gain, enter here. If it's a loss, do this. If you're required to complete the 28% gain worksheet, that's entered there. Remember, those are the collectibles, which in this problem, which we didn't really go through what the problem was, there are collectibles. So, what else do I want to show you? Are there 2 of these? What is going on here? Oh no, I just didn't go down far enough. Okay, and then those 2, there are 2. Yes. Why are there 2? I don't know why there are 2 here. Oh, masters. I don't know. I can't think. I don't know why there are 2 off the top of my head here. There must be a reason. There must be 2 scenarios. I think there are 2 scenarios up there. Oh, my arm is hurting. All right. So, capital losses, there's a lot to them, obviously. Questions? I know, and you're like, she's telling me this stuff while I've got my